Well, hi traders, we've got 19 days left to go until the US election, and it's really all to play for. But this is the period now where we need to start thinking about the different permutations of movement, what's going to happen on the playbook, the scenarios that could affect market conditions and our trading environment, regardless of the strategy that you're trading, whether you're trading off an algo, an EA, discretionary system, or whatever you're looking at. Our market environment will start evolving now, and that's really, really important for us to consider. So we start to consider the playbook around the US election. Now, of course, as we go into the US election, the market will start becoming myopically focused on the propensity for movement and how this may go down. And the media will obviously write more about this, and it will become all-consuming. Placing trades around the US election now is still very troublesome. It's obviously a long way to go. Still 19 days in markets is an eternity. But you're still fighting various trades around macro forces. How will the Fed cut rates? To what extent? US growth, labour market issues that are playing through, volatility in Chinese markets, geopolitical issues, you name it. If you're placing a trade in the dollar, for example, on what we're seeing in Trump's implied probability or other factors around that, of course, you're still swimming against a lot of these macro forces, and it makes trading around it still somewhat more convoluted. But it's a good idea to sort of think about the risks going forward, because as we go into the election, liquidity conditions could change. That could affect the cost of trade. It could affect the sort of movement we're going to be seeing. It could lead to range expansion, and therefore that's something that we do need to consider. Now, of course, as we go into November 5th, we do need to understand the electoral process. Of course, a lot of the early voting has started. We're going to see mail-in voting, which will be counted in most states on the day. And of course, on the day of November the 5th, we could feasibly see disruptions. One suspects that won't delay it too much. And of course, the other factor to think about on the day is whether or not we do see a contested vote and we see a recount coming through. And of course, depending on the swing states, which are the ones we're looking at most more closely, if it is a really close race, then a recount, which could be called by another party, could delay affairs in terms of understanding how those states play out. But if we have a look at the expectations of movement coming through in the moment, it's all pretty calm across asset classes. We've got sort of implied volatility in the options market, expecting sort of gold to have about a 2% move on the day of the election. The Russell, which is the market we can focus on, the small cap index, is expected to have a sort of a 3% move on the day. The S&P, we can see 1 month implied volatility in the S&P sort of trading around 15%, which is not overly elevated. The VIX is a little bit higher, but there's a slightly different calculation there. But certainly the expected move in the S&P on the day of the election is around sort of 2%. And some of the Chinese markets are expected to have sort of 4 or 5% moves on the day. So they're not too punchy. Now, if we go into FX markets, we can have a look at 1 month implied volatility, and we are seeing some hedging of movement playing through, and that's largely to do with what we're seeing on the trade side or tariff side. We can see dollar MEX 1 month implied volatility sitting at the highest level since 2020. We can see dollar CNH, or the offshore yuan, sitting at the highest levels of implied volatility, expected movement over that period at the highest level since 2022, and euro dollar implied vol sitting around the 80th percentile of the 12-month range. So certainly people are starting to sort of say there could be some big movement playing through in the US dollar, and that makes a lot of sense as well. Now, in terms of the sort of playbook that we're looking at, I guess, first of all, let's have a look at the shape of the race. The betting markets, if we look at the exchanges and the prediction sites, are certainly favouring Trump. Some people are treating this with a healthy level of scepticism, given that a few big trades have distorted the market, or at least that's the talk on the town at the moment. But you can see at the moment across the different exchanges that Donald Trump has taken a fairly commanding lead at this stage and is certainly favoured in terms of where the weight of money's been going. If we have a look at the polling, and specifically we do look at the sort of 6 or 7 key swing states, because those are the states which will ultimately decide how the electoral college vote goes down. And we can see Donald Trump is ahead again in all states with the exception of Wisconsin. We'll caveat that by saying here most of those sort of lead that we've seen from Trump is within the margin of error. So it's not particularly confident, but you can see that Donald Trump is probably, if you're taking a view there, slightly ahead in that situation, although I think it's still going to be quite close. If we have a look at the other races, which I think are really, really important, of course, that's the congressional battle, who's going to take the House and who's going to take the Senate. If we have a look at Polymarket, we can see that Polymarket, or the sort of implied chance there, is that the Senate will go to the Republicans with about 78% probability there. I think the way that the race is shaping up, it seems very likely that will go down. The Senate will go to the Republicans. And it's the House that I think is something that we're looking at with a little bit more conjecture, because Polymarket is saying that's about a 55% chance that goes to the Democrats. So we take that at face value. And of course, we are guided by this as in terms of risk. Of course, people are still, as I say, very sceptical about this situation. But certainly at the moment, the base case in terms of the polls and the prediction markets is that Donald Trump is likely to get likely to get the White House. The Democrats are likely to get the House, and the Republicans will take the Senate. Now, of course, if Donald Trump does become president, the odds of him becoming, of the GOP party getting the House obviously increase as well. And a red sweep, I think, would certainly have significant and far-reaching implications for financial markets, which I don't think are priced into the volatility markets at this point. The chance of the Democrats getting a blue sweep or getting both chambers of Congress as well as Kamala Harris getting the White House seem very low at the moment, and certainly that's a playbook that we're not going to give too much credence to. So let's have a look at that base case in terms of how this may play down into markets and trades that we like around that. Certainly, if Trump comes in and we get a split Congress, the obvious situation, which everyone's going to be talking around, is trade policy and specifically around tariffs. Of course, Donald Trump has promised or campaigned very, very liberally on the idea that he's going to put up trade tariffs on China by 25 or 35 percentage points to 60%, which is a massive move, and then 10% blanket tariffs on many other countries as well. Obviously, the idea is to try and close the trade deficit, and he's been talking about that at length. Now, if we have a look at the playbook that we saw back in 2018, where we saw a series of measures and different goods being introduced in 10% tariffs to start with in March 2018, and then we saw a series going through to September. We saw a significant depreciation of the dollar CNH, the offshore yuan. The Chinese depreciated their currency by about 11%. To offset the 10% tariffs that we initially put on. And one suspects this time around, if we're going to put tariffs up 35 percentage points, that we could see a significant weakening that's not being priced into dollar CNH at the moment. We've only seen about a 2.5% move up in this recent rally that we've seen in dollar CNH. So, of course, that's something that we'll be watching very closely. And that's probably why we're seeing some hedging in the volatility space. And, of course, in 2018 and into 2019, we did see the Chinese equity market having a big fall as well. So we saw that dropping about 33%. So one suspects if we were to see the tariffs being placed on, the Chinese equity market could underperform at a time when, of course, they're really trying to push out this reflation trade, take the shackles off local governments, and that's something we are watching. Dollar MEX is certainly seeing some big volatility, and one suspects that we could see a sharp move higher in that situation. And also, when we saw the trade tariffs being placed in 2018-19, we saw dollar SAFA up 35% over about a 4 or 5 month period, and also dollar Brazil having a really, really strong move up there as well. But it's also euro dollar, which I think is really interesting. We're coming at a time when relative growth rates in the US are looking pretty compelling relative to Europe. Savings rates in Europe are much higher. That's a sign of what we've been seeing. And so, you can have a look at that. And one suspects in this situation that tariffs would see euro dollar pushing sort of down towards 105 or wherever spot is at the time. But certainly the market would be running long US dollar positions and also looking at long US equity positions relative to China in that. I think it's the red wave that really is being underpriced at the moment. If we were to see that happening, which, as I say, is about a sort of 40% probability in the eyes of poly market. Now, the first thing you're going to see in that situation is Donald Trump seeing this as a strong mandate that the American public like his policies and that have given him a blessing, not just go hard on tariffs, but other areas as well. So tariffs would give the dollar backbone, but it's the other areas of policy which I think in this situation he'd be able to pass through Congress without the Democrats having the House. He'd be able to pass a lot of the factors that we've been seeing. Deregulation of businesses, very, very positive indeed for US equities. Certainly around financials, healthcare stocks, energy stocks should all do quite nicely in that. He'd move away from Harris's proposal for clean energy. And of course, in that situation, you can have a look at the ICLN, the clean energy ETF, and look at going short in that situation. I think that would be quite an interesting trade there as well. We're also looking at the idea about a massive fiscal response as well there. He's promised to roll over the Tax Cuts and Jobs Act in entirety at the end of 2025. The increase in the fiscal deficit as a result of that would be significant over the next decade. And of course, in that situation, along with potential a small corporate tax cut, you could see bond yields rising quite sharply on the back of that. So if bond yields were to move up, that brings in currencies like dollar yen, very sensitive to what we've been seeing in the bond market. Of course, dollar yen would rally significantly in that. Dollar Swiss would rally significantly in that. And of course, if the bond market was to sell off as a result of the expected increase in supply that would come from this, I think the trade then is just buy America. Buy the Russell short. You could obviously offset that by being short China, but certainly one would expect the Russell 2000 to work quite nicely. Those companies that are driving those revenues inwardly and are producing back in America would outperform significantly. But of course, in that, if you're going to get the fiscal response, the deficit spending, the tax cuts, which would be able to be passed through Congress, as well as trade, the US dollar and US assets would significantly outperform, I think, other markets. Now, I think, as well, if we look at the other permutation of Kamala Harris becoming president of the United States, but also a split Congress. Well, first of all, I would suggest that it depends on where the polls are and how much is being priced into the US dollar and various parts of the market in terms of trade policy. Because if the market sort of gets expectations that we're going to see a Trump win and therefore trade tariffs coming through, if we were to see Harris come in, obviously you're going to see a pretty sharp reaction playing through in markets, and you're going to see the dollar coming under pressure as a lot of that positioning gets unwound very quickly going forward. So certainly that's the big situation. But given what she's been talking about, corporate tax increases and other fiscal measures, one suspects they wouldn't be able to be passed, given that the Republicans are most likely to get the Senate. So it's going to be stalemate, business as usual, a lot of that positioning coming out, and that's where we're going to see the initial move. But I think really the market's been watching the polls, the betting markets, and trying to devise this idea about, are we going to see a split Congress? Could we see a red wave? I think a red wave certainly being underpriced, because I think the situation there would be significant. But if we do see Trump winning and a split Congress, then it's really all about trade tariffs and looking at that 2018 policy playbook and saying to ourselves, how will these countries respond? What could they do to their currencies? How could they make counter moves? And it's on to play for. So certainly the market at the moment, buying volatility in various dollar pairs, fairly sanguine in other markets, but it could be on. One to watch.